Well, what to do in a correction happens? Well, let's first start with the basic premise of why would a correction happen in the first place, right? One, stretch valuations, maybe 20 to 23 times, more so for the broader end of the spectrum. So corrective move could happen there. Now, there are no additional positive catalysts. The results that have come out thus far, 50% of the Nifty weightage, haven't exactly set the stage on fire. And if the budget doesn't provide any positive catalysts, there are no further catalysts to take a market which is already expensive further higher. That's point number two. As I said, there are earning disappointments in banks, and global cues aren't exactly the most positive. And of course, unseen events can take the markets lower. Now, if a correction happens, what will correct the most? That's the second thing that comes on the minds of people, right? So, one, the unanimous call is brace for larger drawdown in the mid stocks, which is small and mid cap stocks as opposed to large caps. But that is not to say large caps will not correct. So keep in mind the fall may be higher in industrials and financials because industrials have the highest valuations, financials are the most liquid. And the pockets of outperformance may be staples, maybe IT, essentially the defensive names. So that's essentially what will correct the most. Now, where is it? You should look for pockets of earnings strength because where there are earnings growth is where the markets will go first when they start buying the market. So technology earnings may shine if global growth picks up. Energy earnings are expected to be very strong relative to some of the other sectors and because of the valuations. Budget impetus to consumption might help earnings for the staple companies, so you got to watch out for that. And remember, defense and railways might be expensive, but they have a very strong earnings trigger for a number of years. So in the event of a sharp correction, the first port of call might also be those stocks because there is earnings comfort in those names. Keep in mind though, that markets may stay positive for a lot longer than what you think the market should because the valuations are expensive. Domestic mutual funds are sitting on over 1 lakh crores of cash and therefore they'll come in to buy at the first sign of a fall. So 5%, 10% maybe max, and meaningful correction should be used to increase exposure in Indian equities because it's a great long-term story.